Hey friends, so I own 50 stocks in my dividend stock portfolio, and it's been a while since I've done a comprehensive portfolio update. It was actually November of last year when I did that. Now that we're in April, about 5 months has elapsed. It's time to go through my portfolio and see how I'm doing against my passive income goals. I have my Dutch Bros coffee here today. I want to sip this coffee as I go through my portfolio with all of you today. Let's go on a fantastic voyage, just like Coolio, through my 50 stock dividend stock portfolio. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first thing I want to do is I wanted to share the portfolio with all of you. Over on Patreon, I share the full thing. I have all the positions, the percentage allocation to each of them. But here on YouTube, let's just go through the 10 top positions right now on the screen. Check it out. These are my top 10. Some of these are going to surprise you, but Starbucks right now is my number one position. And a fun fact for all of you, when we look at Starbucks right now, it's actually greater than Johnson & Johnson in value by about 22%. So Starbucks has really surged in value over the last 5 months and has surpassed Johnson & Johnson. But that's my number one, Starbucks. I'll probably do a whole nother video on these positions, and so I don't want to go into too much depth right here, but I do want to give you a snapshot of what they are. And so Starbucks comprises a staggering 10% of my overall portfolio, and it contributes in terms of the dividend income 6.5% of my overall dividend income. That obviously gives me exposure to restaurants, a little bit of technology as well, a lot of international expansion as well. Johnson & Johnson is my healthcare giant that I own in my portfolio. It comprises a staggering 8.2% of the portfolio, and it contributes 7.2% of my overall passive income from dividends. PepsiCo is my largest CPG food company in the portfolio. It comprises 7.4% of portfolio value, and it comprises 6.6% of my passive income from dividends. Now with McDonald's, I have another restaurant stock, although I look at it as half restaurants, half real estate, because their real estate portfolio is a big anchor, a big compelling selling point as to why I invest in this company. But nonetheless, you can see right away here, just looking at my core four, that I'm probably over allocated towards the restaurant industry. With McDonald's, I have 6.7% of my portfolio value locked up in that stock, and it is comprising 4.7% of my dividend income. Now, a lot of you are going to be surprised here, but my number 5 stock is actually Apple. This is a large position for me at 4.5% of the portfolio value, but it only drives 0.8% of dividend income. The thing to keep in mind with Apple is it's a long-term dividend growth stock for me. It does not provide current dividend yield. But what I want to talk about in the video today, surprisingly enough, is how I can basically retire within 10 years. I'm talking about my 10-year plan, and I'm going for fat fire. I have a family. We're a family of 4. We have a higher cost basis of living, and so I'm looking at some goals today. I really have my 10-year plan, if you will. And so stocks like Apple, do they really help me in the next 10 years? Not necessarily, because it's such a big portion of my portfolio, but it drives such a small amount of dividend income. So some investors might say, hey, Ian, just sell the Apple and redeploy it in something else that pays more yield. But for me right now, I'm also looking at my portfolio multi-generationally. I'm looking at it for the long term. I'm not going to sell my Apple, but I realize consciously that I've made a trade-off. I've delayed my fire. I've set the bar higher. I've made it more difficult to reach fire in the short run because I own stocks like Apple, but so be it. It's an important part of my portfolio, and I think that technology exposure is really important. But anyway, I want to keep going. As you can see on the screen in front of you right now, my number 6 stock that I own in terms of position size is Raytheon Technologies. This is my defense sector stock. I like that this one has really climbed through the ranks of my portfolio. I think some of you who have not seen this for a while, you're probably going to be surprised by what you're seeing. I have more diversification than before. I used to be CPG, Ian. Now I'm really PPC, Ian, because this is just more diversified than it used to be, which is nice. And so Raytheon is 3.9% of portfolio value. And in terms of dividend income contribution, it's driving about 2.8% of dividend income. That's a dividend grower as well. Now, finally, we're getting to CPG. I've got Procter & Gamble coming in here in the next spot. Procter & Gamble is 3.7% of portfolio value, and it's 2.9% contribution of my overall passive income cash flow from dividends. Now I've got the Home Depot coming in, which is a retail. I love this. You're seeing the diversification. So far, I think the only thing I've probably been overly concentrated in is restaurants. But other than that, I've got healthcare, I've got CPG food, I've got technology, defense, CPG, just consumer packaged goods. Now I'm down to retail. How awesome. This portfolio did not look this way. It really did not look this way in years past. So many of you probably remember times in the past where I was all about the sin stocks. So many of you in the past probably remember times when I was all about CPG. Now you're seeing the portfolio really build out and hold its own in terms of being a defensible, diversified portfolio. Put in the comments below if you're seeing that as I'm seeing it, because when I look at my portfolio, why I like to analyze it over the years is to really see how it evolves to hit my goals. And I'm starting to really hit my goals in terms of diversification. But as you can see on the screen right now, with Home Depot, it comprises 3.7% of the portfolio value, and it comprises 3.4% of my overall cash flow. I've got 3M coming in next. This one's been a troublemaker in my portfolio, but nonetheless, I'm holding strong. I'm reinvesting dividends. Maybe I'll buy a little more as well. We'll see, but it surely has its issues. And quite frankly, what I'd say about 3M that concerns me a little bit is the recent J&J settlement. So J&J, it appears they have a settlement on the way for the talc powder related lawsuits that they've been facing. The stock has been up on the news of this settlement, but as you can see on the screen, the settlement is just a massive settlement. It's a lot of money, and it sets a precedent, quite frankly, for other stocks, perhaps like 3M, and it just gets me worried because maybe J&J can shoulder that kind of settlement, and maybe that huge settlement of that magnitude is actually a positive in the eyes of Wall Street. Obviously, before I go on any further, my heart does go out to anyone affected by any kind of medical issues, and I'm not trying to talk whether J&J is in the right or wrong. I don't know. That's left for the courts and for the lawyers and so on and so forth, but I'm just trying to speak from a business standpoint that when I look at a settlement of this magnitude, it's huge, and maybe J&J can shoulder it, but if that sets a precedent, 3M, I don't know if they can shoulder something like that when it comes to the earplug issue they are facing. But nonetheless, I continue to hold 3M. I'm going to see how it plays out over long periods of time. I'm speaking more here just to the general landscape, why I'm looking at stocks like SCHD or ETFs, because it's more important to be diversified than ever before, because the single company risk, it's huge these days, because just look at J&J, just on the talc powder, how big of a settlement, and then think of a company like 3M, how they have all these products, and how if one or two of them goes bad, if there's an issue with one or two of them, boy, it could create a lot of economic downside. And so I'm all about diversification these days. But as you can see on the screen right now in front of you, that is 3M. It's 3.4% of the portfolio value. It's 6.4% of dividend income. It's a higher yielder. And the last one there on the top 10 is Kimberly-Clark. And this is another CPG company. It is 3.3% of the portfolio value, and in terms of dividend income, 3.7%. And it's so interesting because on these top 10, if I just add up the value percentage, just how much of value do they comprise of the portfolio? They comprise about 54.8% of my total portfolio. So I have in my top 10 stocks that I own 54.8% of the portfolio value locked up. So whereas I have 50 stocks, this is a big portfolio, it is really heavy on the most important core stocks of the portfolio. So that's something I really want to illustrate, and that's by design. I've done that on purpose. Every stock in the portfolio has a role to play, but the ones at the top of the portfolio, they have the most important role to play. I want to go next into a breakdown by industry, just so you can understand how my portfolio is diversified by industry, but then I want to get into some insights that I learned when I went through my portfolio update. By the way, if you're enjoying the video so far, don't forget to smash that like button product, and it means the world to me. And if you want to learn even more about my dividend stock portfolio, go ahead and check out Corner Patreon. I will link to that in the pinned comment below. Over on Corner Patreon, I include the entire portfolio, not just the top 10, but the entire thing. And I include the percentage allocation to each position there. And so that's really cool. And I'll be doing probably a more extensive video over on Corner Patreon about all of the positions. So check that out. You'll really enjoy it, I think. But as we keep going, check it out on the screen. This is the breakdown right now by category. And you can see here that restaurants, as I had flagged on the last screen, is 17.1% of the portfolio value, maybe because of Starbucks' success and just because I've been adding a lot of money to McDonald's as well. Boy, those stocks comprise a good percentage of the portfolio value. You could say I could probably stand to be more diversified there. Oh well, I've placed my bets, that's how it is. But you can see in general, quite frankly, that I'm less dependent on SIN stocks. SIN stocks are now only 7.8% of portfolio value, but they are 17.1% of dividend income. But I am less dependent on SIN stocks than ever before, and so that's nice to see. And you can just see here, in general, I would say my portfolio is more diversified than ever before. I've got great diversification between restaurants, CPG food, healthcare, SIN stocks, industrials, technology, utilities, so on and so forth. I'm proud of what I'm sharing on the screen here because the portfolio probably was not always this way. I don't remember it being this way. It is more diversified than it has been in the historical times. But please, again, do share in the comments below what you think of the evolution of my personal dividend stock portfolio over time. And so without further ado, what I want to do now is get into something really exciting. But boy, this has been a long week. I'm telling you all, I got to have my coffee, get my energy here. Gotta enjoy the Dutch Bros. This stuff is so good. I'm long Dutch Bros, by the way. It doesn't pay a dividend. Out of these 50 stocks, there are only 2 in there that do not pay dividends. One of them is Alphabet, ticker GOOGL, and the other one is Dutch Bros, ticker BROS. I love investing in coffee. So I want to go through the whiteboard now. I want to talk about what I have put up here on the whiteboard. By the way, put in the comments if you remember the corner days over on when I used to live in the old house and I had the whiteboard. I'm going back to my roots. That's what I got to do, old school all the way. I want to go through some insights. And so there are going to be about 7 insights today that I want to go through before I end this video. I've got a lot of ground to cover, so let me get on with it. So check it out on the screen right now. The first insight I just want to share is, what are we looking at today? We're looking at a portfolio update from April 8th of 2023. We're comparing it versus November 1st of 2022. I'm down 1 position because I sold Norfolk Southern. I thought there was too much risk exposure there due to the terrible event that happened in Ohio. And so I have trimmed down to 50 positions. I will be back up though pretty soon at 53 positions because Kenvue is on the way from J&J from the spinoff. And also I'll be adding XYLD and SCHD as I discussed in the last video. I'll link to that last video in the pinned comment below. I would say the interesting thing just about level setting here is a fun fact and a big difference from the last time I did one of these is Starbucks is now 22% larger than J&J, and Starbucks is 10% of my overall portfolio. May the good fortune continue. I think that stock has a lot of runway left as long as things go smoothly with their expansion in China. Now, worth noting, I have a separate bond portfolio with treasuries and also a few bond ETFs. That I just share over on Corner Patreon. I'll be doing an update on that soon for my Corner patrons. And so that's just the quick update there. Now, the second thing I noticed when I went through my portfolio and that I think is really important, because sometimes I get comments on YouTube, Ian, what about XYZ stock you talked about? It's down. Has your portfolio crashed because of it? This and that and the other. I want to share with all of you why it's so important to understand how I have optimize my portfolio. The way my portfolio is optimized, as I discuss here under concentration, is I am really concentrated in my top most important stocks. But I'm a collector of sorts, and I try to make dividend stock investing fun. I have stocks like Dutch Bros, for example, but this is a smaller position. I have it more for fun, and I like to invest where I'm passionate. Of course, I would never buy a stock I don't believe in the future of, but some of these stocks that are more fun positions, they're a lot smaller. And so sometimes I guess I'm not always clear about which ones are super small and which ones are a lot bigger, but you just got a flavor of my top 10 that I shared. And I also want to go through a concentration analysis analysis of how I've concentrated around certain positions. So as you can see on the screen right now in front of you, you can see my top 5 are 36.7% of the portfolio. I have an average position size in the top 5 of 7.34%. But the top 10, as I already discussed, 54.8. But here's where it gets really, really interesting. Top 15, I'm up to almost 69%. Top 20, 78%. You can see the top 20 stocks out of my 50 comprise the lion's share of the portfolio, almost 80%. And if you look at those bottom positions, as you can see on the screen, my bottom 30 positions, they only comprise 21.9% of the portfolio, an average position size of less than 1% each, 0.73% each. So I have a very long tail of ancillary positions, but my portfolio, it's very core focused. That being said, every single stock in the portfolio, it plays a role. I enjoy having them all, and I try to keep it fun. I try to keep it diversified. It's going to be even more diversified when I add SCHD. That only has 30% overlap with my existing positions of 50, and so I'm going to add another 100 or so positions there, but only 30% overlap, so that's going to instantly diversify, which I think is more important than ever, given the type of single company risk that we're seeing these days. For example, with J&J, again, I was surprised the stock was up so much on the settlement news. Put in the comments below what you think about that settlement. I just saw the numbers and I was like, wow, this is a lot of money for this company. And so I guess Wall Street, though, just feels like at least those that issue, that whole topic of the talc powder lawsuits is left in the past and everyone can move forward here. But boy, it seems like a lot of money when I just look at it from the company's position. And with that, I want to keep going, though. I have more insights to share. I want to go into number 3. So as you can see on the screen right now, the next thing I want to do is I want to talk about my progress. And so there are 3 main levers how I can improve my portfolio and get to my goals. And my goal really is living off of passive income. Surely I could do that probably sooner than later if I just took what I have right now and dump it all into high yielders. But that's just not what I am about. Now, worth noting, my overall dividend portfolio is yielding on average 3.1% current dividend yield, 3.1%. Now, what I was trying to say about the high yielders is I could triple that if I just put it all in a stock like Altria, for example, that's yielding like 8.4%. If I find some of those higher yielders around, say, 8, 9% and just put it all there, hey, I could triple my dividend income right now. But again, that's not where I'm at from a risk tolerance standpoint. And from a longevity standpoint, everyone has their own path. I'm not saying there's anything wrong with the high yield path. I've drawn inspiration from that. That's why I'm getting into XYLD. And I've been adding more money, a lot more money to Altria. I'll talk about that later. But again, for me, for myself, I have a system that works for me, given my level of risk tolerance and what I'm trying to accomplish, that my 3 main levers to hitting my goals, say within 10 years, are net new capital. I'm always adding. Dividend reinvestment. I'm trying to reinvest most of the dividends, although I'm using some right now to pay for travel-related expenses. It's helping our family experience more travel, like our recent Disney vacation at Disney World, Orlando, Florida. And also dividend increases, of course. I love dividend increases. They help me reach my goals even quicker. And all 3 of these levers play into the dividend snowball. Now, what I want to say is over the last 5 months, here's my progress. The portfolio value overall from these 3 levers is up 5.3%. This is pretty good because I have a larger, more seasoned portfolio. It's harder to move the lever, but up 5.3%. I'm proud of that. Dividend income is up 4.6%. And so that is really exciting to see, but I want to share projections based on where I'm at now. How do I get to where I want to go? That's what's fun. That's what's going to be under topic number 4, these projections, especially looking at like a 10-year time horizon. So as you can see on the screen right now in front of you, the projections, I'm going to say, hey, let's say I'm doing 8% annualized dividend growth here. It's probably higher than that because we know just over the last 5 months, dividend income is up 4.6%. And we know 5 months times 2 is only 10 months, but the year has 12 months. And so I'm rounding down quite a bit. But I also believe we're kind of seeing a slower growth period in society. And so Let's just say conservatively, my income, if I keep up doing what I'm doing, it's going to grow by 8% per year on average. Well, if I use the formula here, if I take 100% of my current kind of cash flow and I say that's going to grow at 8% per year, compounded over 10 years, well, what that means is in about 10 years' time, my dividend income is projected to be 216% of the amount it is right now. That's pretty good in terms of projections. I'm happy with that, but it's not good enough. I would really like to see it more like 300% of where it is right now to reach my kind of dividend dream state, if you will. And that's kind of what I'm going for, is the dividend dream state. And that's the next topic, as you can see here. I want to show you on the screen right now. Check it out. What do I have to do to reach that dividend dream state, to kind of fill the gap? And basically, what it would take is 12%. And so if I do the same formula here, if I take 100% of my current dividend income, I multiply it by 12% and compound that over 10 years, I will get to 311% of my current dividend income in 10 years' time if I'm growing that dividend income by 12% per year. And quite frankly, I think I could get that 8% kind of bottom of the range target up to 12%. And fill that gap. I just need to do 50% better. And honestly, I don't think I'm really at 8% now, because over the last 5 months, my dividend income is up 4.6%. If I annualize that, that's actually 11.96%. Now, look, don't get me wrong. The last 5 months have been pretty good. And I think we're at the tail end of a really kind of bull run. And so maybe dividend growth will slow down. Maybe these companies will slow down a bit in that dividend growth lever of the 3 levers I have of adding net new capital, of reinvestment, and dividend growth. It's going to slow. And so that's why I originally projected it 8%. But to get back up to that 12%, maybe I'm just going to have to work a little harder. I'm going to have to deploy more money. I'm going to have to be a little bit more frugal. And quite frankly, maybe I skew net new money more towards higher yielders to get to my dream state. I think I can do it. And if I can just do what I've already been doing, despite things possibly slowing down, within 10 years, I'm going to be over triple where I'm at right now. And so that will really get me to that dividend dream state. And so I want to share some more with all of you. As you can see on the screen right now, the next thing is, after filling that gap, or in terms of that, what do I need to focus on to get to that dividend dream state within 10 years or less? And so what it really tells me is, first and foremost, I'm surprised even what I've accomplished in the last 5 months. I'm surprised when I looked through this portfolio of 50 stocks, how complex it all is. How did I even create this complexity? It took a long amount of time, but it was just baby steps. And it just goes to show how powerful it is as an investor to take baby steps over time, brick by brick, to build something wonderful. And I just know over the next 10 years, maybe even less, if I take the same approach, I'm going to build something wonderful by just going step by step by step. But to compensate for potentially slower dividend growth and to get to my dividend dream state even quicker, what I plan on doing is really focusing a bit more on the higher yielders. I'm going to be adding SCHD for immediate diversification and a little bit of higher yield, because that starting yield, it's higher than my current portfolio current yield. I'm going to add some XYLD for some higher yield. And I'm really focused these days on Altria. I want to double my position, maybe even more, to get it to that core 5. Right now, it's not even in the top 10. It's just below the top 10. And so I need to work on that a little bit. But I'm also showing some stocks here like Realty Income, BTI, Duke, Southern, Bank of Montreal, Pfizer, Universal. These are the ones right now I want to focus on because they have higher yields. But also, I don't want to forget my core 4 goals with PepsiCo, McDonald's. I need to make those a little bigger as well. But that's going to be my focus over the next, say, 10 years. Of course, I can't project 10 years out, but even in the next 1 or 2 years, I really want to focus on these stocks because it's going to help me get to my dream state quicker. And maybe if I can grow my dividend income by more than 12% per year, it takes years off of getting to that dividend dream state. Now, as I was going through my portfolio, there were a few random fun facts that I wanted to share with all of you as well. I want to actually encourage you at home, if you have a dividend stock portfolio or a stock portfolio in general, take the time in Microsoft Excel to update it from time to time and to really analyze each row in the spreadsheet, because it's so interesting. What I found as a dividend stock investor is I analyze this stuff a lot, mainly because I have this YouTube channel, but also it's really a set it and forget it strategy. There are times in my life where, quite frankly, I don't even spend that much time actively analyzing the positions, especially the bottom 30 positions that are each worth on average less than 1% each of portfolio value. And so it's fun when I do one of these comprehensive updates, I get to go into each of them in some depth. But as you can see on the screen right now, these are some of my fun takeaways that I found from stocks. Now, these are mostly the smaller stocks in the portfolio that I don't look at quite as frequently, although Caterpillar, Pfizer, Leggett, they're a little bit bigger. But anyways, I was surprised with CAT that this thing has been rallying, but the PE is still really low. And so that one is a surprisingly low PE. It's lower than I would have thought. Pfizer is cheaper than I would have thought at a PE of 12, but I know they have a big unknown with their acquisition they're making. Leggett has a frightening payout ratio. I've already flagged this in past videos. I'm continuing to hold. Maybe I'll even add some more money to it, but that frightens me. It's facing some cyclical challenges right now. Marriott Vacations Worldwide, VAC, has a PE lower than I would have thought, but they are going to be cyclical if we head into a recession, and so maybe that's being priced in. Viatris, EPS continues to decline, but the PE remains to be very cheap. I'm looking at Viatris these days like an annuity model. It's kind of shrinking in earnings over time, but the PE is so low that it compensates for it, and they're just going to continue to pay out their dividend. And at a certain point, I bet you the EPS declines will flatten out over long periods of time. But that's an interesting one. It's a different kind of stock than anything else in the portfolio. And in the past, I've talked about it a lot, but it's a smaller position in the portfolio. It's one of those kind of bottom 30 positions. But I know sometimes people write into me, Ian, what about Viatris? Hey, it plays a role. It's exciting. But again, it's bottom 30. I love it. I'm not going to sell it, but it's a unique position all to itself. Hasbro, despite business challenges, seems cheap here at the PE in the 11s. I own it. My kids own it. I'll probably add more for my kids' positions at these points. Hasbro, for me, I don't know if I'm going to be adding too much of that position more to my personal stock portfolio, but certainly to the kids' portfolios, that could be a ton of fun. All right, everyone, if you enjoyed the portfolio update today, please go ahead and click the like button. It means the world to me. If you want even more of this kind of content, head on over to Corner Patreon. I will link to that in the pinned comment below for a more extensive portfolio update. Also, don't forget to subscribe. I have new videos on the way all the time. It's been a busy week at work, and so your support here on YouTube, I'm doing this on my Saturday with my coffee. It really means the world to me. Before I go today, I want to offer a full disclosure. In terms of full disclosure, I own the stocks mentioned today. There's a lot of them. I am long Starbucks, ticker SBUX. I'm long Johnson & Johnson, J&J, PepsiCo, ticker PEP. I'm long McDonald's, MCD, Apple, AAPL. I'm long Raytheon Technologies, RTX. I am long Procter Gamble, PG, Home Depot, HD. I'm long 3M, MMM, Kimberly-Clark, KMB. I am long Dutch Bros as well, ticker BROS. I am long so many more stocks that I have to find here. I am long Realty Income, ticker O. I am long BTI, ticker BTI. Duke, DUK, Southern, SO, Bank of Montreal, BMO, Pfizer, PFE, Universal, UVV, PepsiCo, PEP, McDonald's, MCD. I think I already did those. I am also going to be long very soon. I plan on adding XYLD and SCHD as well. I am also long Caterpillar, ticker CAT, Pfizer, PFE, Leggett & Platt, ticker LEG, Marriott Vacations Worldwide, ticker VAC, and Viatris, VTRS, and Hasbro, ticker HAS. I own all of those stocks in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Thank you for watching the video today, everyone. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.